Okay. It is Wednesday, February 11th, 2026. And if you've checked your portfolio this morning, specifically your Ethereum holdings, you are probably staring at the screen and asking yourself, what on earth is going on?
Hmm.
I mean, we are hovering between $1,900 and $2,000. We are testing support levels that we haven't touched in ages.
It is grim out there.
Hmm.
I mean, if you only look at the price charts, you'd think the network was about to shut down.
But, and this is why we're doing this deck dive today, if you close the trading tab and actually open, say, the GitHub repositories or look at the settlement data, it is a completely different reality.
A different universe.
The network has literally never been faster, it has never been cheaper, and the institutional pipes, they seem to be finally fully connected.
Almost schizophrenic, right?
Mm.
We're seeing this complete divergence between price and fundamental value. It's a moment of technical triumph versus market anxiety.
Exactly.
And we have a whole stack of sources today, from SEC filings that just dropped to technical postmortems on the Fusaka upgrade, even some very telling on-chain movements from Goldman Sachs that suggest the market has this completely wrong.
That is the tension we need to figure out. Ethereum is going through this massive identity shift. It's moving away from the world computer narrative of the early 2020s to becoming this global settlement layer.
Right. It's becoming the boring, invisible plumbing of the internet.
And the big question is, does boring make money?
That's the billion-dollar question.
Right.
Because usually in tech, boring is where the real sustainable value settles.
So let's start with the elephant in the room, the regulators. For the last few years, the SEC has been this dark cloud hanging over Ethereum.
Always. Is it a security? Is it a commodity? Are they going to sue the foundation? All of that. But we just got to look at their 2026 examination priorities, and there's a glaring omission.
This is arguably the biggest news of the year, and it's flying under the radar because it's about what didn't happen.
The SEC released its annual list of examination and enforcement priorities. For the first time since crypto became a mainstream topic, Ethereum is nowhere on it.
It's just gone.
Completely absent. In previous years, digital assets, and specifically smart contract protocols, were like top 3. They were explicitly targeting staking DeFi interfaces. Now, silence.
So how should we read that silence? Is that negligence or is it a ceasefire?
I think it's a de-escalation. It signals that the regulatory war on Ethereum is, for all intents and purposes, over.
Wow.
By approving the ETF products we saw last year and now removing ETH from the enforcement hit list, they're implicitly categorizing it as a commodity. They're treating it like oil or wheat.
Okay, so they're not saying it's safe, but they are saying it's not a security violation to hold it.
Exactly, which you'd think would send the price skyrocketing.
You would. If the regulatory risk is gone, institutional capital should be flooding in. But that brings us to the paradox. Retail is panicking. The price is down 3% just since we started talking.
The retail panic is understandable. We're trading at, what, $1,939? Technically, the chart looks broken.
It looks awful.
If you're a trader looking at moving averages, the bears are in total control. There are downside targets at 1760. Some are calling for a flush down to 1400.
Ooh, that would be painful.
It would be capitulation.
Yeah.
But while retail is selling because of the chart, the smart money is buying because of the asset class.
You mentioned Goldman Sachs earlier. We have new filings from them. Now we hear institutions are coming every cycle. It's almost a meme.
It is a meme.
Is this actually significant, or is it just Goldman hedging, a tiny fraction of their book?
No, this is significant. The filings show Goldman now holds approximately $1 billion in ETH ETFs. But the raw number isn't the headline here. The headline is the ratio.
The ratio, how so?
Historically, even when banks dipped their toes in, it was maybe an 80-20 split. 80% Bitcoin as digital gold, and maybe 20% Ethereum as a high-risk tech bet. Goldman's current holdings are almost at parity. They hold nearly equal amounts of Bitcoin and Ethereum.
That is a massive shift in allocation strategy that says they view them as complementary assets, not just crypto.
Precisely. They aren't treating Ethereum as a speculative tech stock anymore. They're treating it as a yield-bearing commodity.
A yield-bearing commodity.
Think about it. In a world where interest rates are stabilizing, an asset that offers a native yield, the staking rewards, plus the potential for appreciation is incredibly attractive to a conservative bank. They're buying the cash flow.
So while the average person is staring at the red candles and panic selling, Goldman is treating this as an accumulation zone. It's the classic bank play.
Shake out the tourists, buy the dip, and the on-chain data backs this up. It's not just Goldman. We've seen exchange reserves drop by 220,000 ETH recently.
That's a huge number.
It's the largest outflow since October 2025. That money isn't just vanishing, it's moving into cold storage.
And we also have those accumulating addresses, the wallets that have never sold and hold over 100 ETH.
Right. Those entities now control 23% of the entire supply. That's 27 million ETH. That is a staggering amount of supply shock just waiting to happen.
But why now? What changed in the last 6 months to make a bank like Goldman comfortable with a 50-50 split? I
Right.
have to assume it's the technology. We had the Fusaka upgrade in December.
That's the catalyst. Fusaka was the moment Ethereum stopped being an experiment and started being industrial-grade infrastructure.
Okay, so we covered Fusaka briefly when it launched, but I want to get into the weeds on this PeerDES thing, peer data availability sampling. We keep hearing the term. What does it actually mean? And don't just give me the "it makes it faster" line.
Okay, fair enough. To understand PeerDES, you have to understand the bottleneck Ethereum had for a decade. Every single node, every computer running the network had to download and verify every single piece of data.
Right.
So if you wanted to process more transactions, you had to force every computer to download more data. That creates a natural limit.
The scalability trilemma. You can't be fast, cheap, and decentralized all at once.
Exactly. Until PeerDES. PeerDES cheats the trilemma using probability math. Instead of every node downloading the massive blab of data that Layer 2s post, the nodes just sample it. They grab tiny random chunks.
So it's like taking a poll instead of counting every single vote.
That's a perfect analogy.
That's
Similar logic. If I have a massive file and I ask 1,000 nodes to each check 50 random little chunks and every one of them says, yep, my chunks are here, I can be mathematically certain with like 99.99% certainty that the whole file is available.
Without needing to hold the whole file yourself.
You don't need to hold it to know it exists.
Yeah.
And this just clears the bottleneck entirely. Because of the sampling, the network can handle massive amounts of data without clogging up the main chain.
And this is why we're seeing combined ecosystem throughput over 100,000 transactions per second.
100,000 TPS. It's Visa level scale. It's beyond Visa, really. And it's why Layer 2 costs dropped by 60% overnight.
Wow.
But, and this is critical for investors listening, it had a massive economic side effect.
The inflation.
Yes. For years, the whole narrative was ultrasound money. The idea that high usage would burn so much ETH that the supply would shrink forever.
But PeerDES made the network too efficient.
It's too cheap to use. So we aren't burning enough fees to offset the new issuance.
So we're currently inflationary.
At about 0.74% annualized.
So the ultrasound money meme is dead.
I wouldn't say dead. I'd say it's been traded for sustainable growth. We aren't shrinking the supply, but we are scaling the users.
Yeah.
And that inflation goes to the stakers.
Right, and staking rates are at an all-time high. Over 30% of the supply is locked up.
So if you are staking, you are easily beating that inflation and earning a real yield of around 3.5%.
Which brings us right back to Goldman Sachs. They don't care about deflationary memes. They care about real yield.
Correct. They want a predictable internet bond. And that's what Ethereum has become.
This efficiency has also led to a very clear unbundling of the ecosystem. It really feels like the mainnet and the Layer 2s are completely different products now.
Oh, they are. The Ethereum mainnet is no longer a consumer product. It's a BDB chain. It's a high-value settlement layer for banks, for sovereign funds, and for the roll-ups themselves. You and I, we aren't supposed to transact on mainnet anymore.
We live on the Layer 2s. That's the B2C interface. But this brings up the competition. Solana is still out there, and from what I see on X, Solana is having a lot more fun.
Solana is winning the casino vertical, hands down. If you want to trade meme coins, do high-frequency speculation, or spend money on consumer apps, Solana is the place. It's fast, it's monolithic, it's easy.
The casino versus the bank.
That's the market segmentation right there. Ethereum has secured the bank vertical. It holds 65% of all real-world asset tokenization, treasury bills, gold, real estate.
And the stablecoin market too, right?
57% of the $165 billion stablecoin market.
Yeah.
The serious money is on Ethereum. The fun money is on Solana.
But even within Ethereum, that fun layer, the L2s, is becoming a battlefield. We've got the Optimism superchain versus the Polygon egg layer.
It's a total battle of philosophies. Optimism is winning on volume. They have nearly 60% market share. And they just introduced a sequencer revenue buyback.
What's that?
They're using 50% of the revenue from the chain to buy back their own token, OP.
Oh, finally connecting the token to value.
Right. But Polygon is betting on cryptographic unification. Their ag layer uses zero-knowledge proofs to connect chains mathematically. They're arguing that optimism is too centralized, that it relies too much on trust.
This brings us to a huge topic Vitalik Buterin has been harping on lately. Stage 1 decentralization. He's been really critical of L2s that are just centralized servers with a blockchain label.
He's drawing a line in the sand. He's saying that if your L2 still has training wheels, meaning a small group of people can pause the chain or upgrade the code without a delay, you're not a real roll-up. You're just a fancy database.
Code is law is the goal.
Yeah.
But is that actually what we want? Because I saw this story on Reddit this week that makes code is law look absolutely terrifying. The Open Chaos saga.
Oh, this is a perfect counterpoint. It's a small-scale example, but the implications are huge.
For those who missed it, Open Chaos was a GitHub repository where all the code was governed by popular vote, pure direct democracy. If a pull request got the most votes, it got merged automatically.
No human review.
And inevitably, the internet did what the internet does. A joke PR was submitted that introduced a bug. It made the site crash 1.337% of the time.
Leet speak. So mature.
Right. Funny for a moment, until it corrupted the server-side caching and took the entire project offline. But here is where it gets really interesting for our governance debate. A fix was submitted immediately. Perfect code.
But because the project operates on code as law, the voting process, the fix had to get in line.
It had to be voted on.
And it was stuck. It was stuck behind a PR to port the game doom into the site, and another one that was just a Rickroll video link.
So the community was voting for memes while the entire site was dead.
Yes. So the maintainer's sitting there watching the house burn down, but he can't pick up the hose because the voters haven't approved the water yet.
It's the ultimate dilemma. Do I break the law, override the code, and fix it manually, or do I let it stay broken to uphold the philosophy?
It sounds ridiculous on a small GitHub repo, but imagine if that was the Optimism superchain holding billions of dollars.
That's the whole point.
That is why Vitalik is so obsessed with Stage 1. If we're going to trust the code with our life savings, the code has to be robust enough to handle the Rickroll attacks.
This philosophical stance is also showing up in how Vitalik is spending his own money. There was some FUD fear, uncertainty, and doubt recently because he moved about 16,000 ETH. That's over $30 million.
People panicked. They thought he was cashing out, selling the top.
But he calls it austerity.
He's engaging in what he calls the walkaway test. He believes we are far too dependent on centralized services. If Google shuts down your account, you lose your digital life. If AWS goes down, half the internet vanishes.
We're just renting our digital existence.
Exactly. And Vitalik is selling that ETH to fund freedom tools, open source, privacy-focused tech that works even if the company behind it disappears tomorrow. He's funding the things that pass the walkaway test.
It's a noble goal, but does the market care?
In the short term, the market cares about number go up. But in the long run, the bank vertical, the global settlement layer, only has value if it is truly unstoppable.
Good point.
If Ethereum is just another company that can be shut down, it's worth zero. Vitalik is trying to ensure it's worth trillions.
Speaking of trillions, let's look at the road ahead. We have these bearish charts today, but we also have some wild predictions for the end of 2026. Standard Chartered is calling for $7,500.
That's their conservative case. They see a path to 12,000 if the layer 1 throughput continues to scale. They're looking at the yield, the supply shock, the regulatory clarity, and they just see a coiled spring.
And the tech roadmap isn't finished. We have Glamsterdam coming mid-year. I swear they just throw darts at a map for these names.
It keeps it fun. But Glamsterdam is serious. It tackles state bloat using something called Verkle trees.
We talked about PeerDAS helping with data. What do Verkle trees do?
They solve the storage problem. Right now, the record of who owns what the state is massive. It's really hard to store. Verkle trees allow for stateless clients.
And what does that mean in simple terms?
It means you could theoretically run a secure Ethereum node on your phone with near zero hard disk space.
Why does that matter to the price?
It matters to the security. If you can run a node on a phone, the network becomes truly impossible to kill. It becomes radically decentralized. And that reinforces the global settlement layer thesis. It makes the bank indestructible.
So to summarize where we are on February 11th, 2026, the price is down, retail is scared, but the SEC has backed off, Goldman Sachs is buying hand over fist, the tech has solved the scalability bottleneck, and we are moving towards stateless clients.
Ethereum has become boring on purpose. It has left the excitement to Solana and the L2s. It is focusing on being the bedrock of the financial system,
And the market is pricing it like a dying tech stock.
while the smart money is pricing it like the future of finance.
It's a dangerous disconnect. As we wrap up, I want you, the listener, to think about that walkaway test Vitalik mentioned. Look at the apps on your phone. Look at your bank account. If the people running those companies walked away tomorrow, what would you actually still own?
For most people, the answer is nothing.
Ethereum is trying to build a world where the answer is everything. And that might just be worth waiting out the dip for. That's the deep dive for today. Thanks for listening.